The program focuses on investment process due diligence and the importance of evaluating how alternative investment managers design, implement, and monitor their investment activities. Investment due diligence extends beyond reviewing historical returns because investors must understand the manager's strategy, organizational structure, operational controls, and risk management practices. Alternative investments often involve complex strategies, illiquid assets, leverage, and valuation uncertainty, making thorough due diligence essential for protecting investor capital. The program emphasizes that successful due diligence requires both quantitative and qualitative analysis. Investors evaluate whether managers possess the expertise, discipline, infrastructure, and governance necessary to execute their stated strategies consistently across changing market environments and economic conditions. Investment strategy and investment mandate reviews are central components of the due diligence process. Investors must determine whether a manager's actual investment activities align with the stated objectives, risk parameters, and style described in fund documentation. The program highlights that strategy drift can expose investors to unexpected risks if managers deviate from their original mandates during unfavorable market conditions or in pursuit of higher returns. Due diligence therefore examines portfolio concentration, leverage usage, liquidity exposure, sector focus, geographic allocations, and investment selection processes. Investors also assess whether the strategy is scalable and whether the manager possesses sufficient resources and expertise to execute it effectively. Clear mandates and disciplined adherence to investment guidelines support greater transparency and investor confidence. Investment implementation processes and operational risks are critical areas of analysis because poor execution can undermine even well-designed investment strategies. Investors evaluate trade execution procedures, portfolio monitoring systems, compliance controls, counterparty management, and internal governance structures. Operational risks may arise from inadequate systems, insufficient staffing, weak internal controls, or excessive dependence on key individuals. The program emphasizes that implementation risk is particularly important in alternative investments because many strategies involve derivatives, leverage, illiquid assets, or complex transaction structures. Investors must therefore confirm that managers maintain robust operational infrastructure capable of supporting trading, valuation, reporting, and compliance activities. Strong operational procedures reduce the likelihood of errors, fraud, valuation disputes, and regulatory problems that could harm investor outcomes. Asset custody and valuation practices represent another essential component of investment process due diligence. Investors must verify that assets are properly safeguarded by reputable custodians and that valuation methodologies are transparent, consistent, and independently reviewed. Alternative investments frequently involve assets lacking observable market prices, creating challenges in determining fair value. The program explains that valuation manipulation or weak oversight can distort reported performance and obscure underlying risks. Investors therefore assess the independence of valuation committees, pricing sources, audit procedures, and reconciliation processes. Proper segregation of duties between portfolio management, operations, and valuation functions is also important. Effective custody and valuation controls enhance transparency, reduce operational risk, and improve confidence in reported portfolio performance. The program also discusses the use of risk alerts, portfolio risk reviews, and monitoring systems designed to identify emerging investment concerns. Risk alert systems help managers and investors detect unusual trading activity, excessive leverage, liquidity mismatches, or deteriorating market conditions before problems escalate significantly. Portfolio risk reviews evaluate exposures across asset classes, sectors, counterparties, and risk factors to ensure alignment with investment objectives and risk tolerances. Stress testing, scenario analysis, and sensitivity analysis are often used to assess portfolio resilience under adverse market conditions. Ongoing monitoring is particularly important in alternative investments because rapidly changing market dynamics, leverage, and illiquidity can amplify losses during periods of financial stress or operational disruption. Investment warning indicators and risk management awareness signals provide investors with early evidence of potential weaknesses in a manager's operations or investment process. Warning indicators may include unexplained performance consistency, sudden personnel turnover, weak transparency, strategy drift, valuation irregularities, excessive leverage, or unusually aggressive return targets. Operational warning signs can also involve weak compliance systems, inadequate reporting, or poor segregation of duties. The program emphasizes that investors should not rely solely on performance data when evaluating managers, because operational failures and governance weaknesses often precede significant investment losses. Effective due diligence therefore requires continuous monitoring, skepticism, and independent verification to identify risks early and maintain strong oversight of alternative investment managers and strategies.